Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through a Noise podcast. We have a flurry of central bank decisions this week. Headlining them is the Fed, who stood pat on its rate decision as expected but guided dovishly for the next meeting. BOE also cut by 25 bips as expected. For BOJ, we got a surprise as it hiked unexpectedly by 15 bips while also tapering down its bond purchases by half. The broad trend we are seeing here is the dovish bias across most major DM central banks, aside from Japan. To decode these and more, I'm happy to be joined by Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. Welcome back, Manpreet. It looks like the narrative in the markets have moved firmly in favor of lower Fed rates, especially in the past week. Do we subscribe to the same story?
Hi, Jong. Thanks for having me on again. Yes, I think we do subscribe to the story because the narrative indeed has shifted. So while central banks might have ended up taking the lead in cutting rates, the market focus today is very much on whether the Fed will also start cutting. Now, with recent US inflation releases having largely been in line or below expectations, we now expect the Fed to cut rates twice in 2024 and twice more in the first half of 2025. Indeed, these rate cuts are one key assumption behind our soft landing outlook for the US economy, one which involves slower but still positive growth underpinned by Fed rate cuts. So that's obviously the narrative on the Fed side, but I'd emphasize the narrative in markets isn't just about the Fed and central banks. Indeed, in the US, the ongoing election campaign also remains another focus. If you look at polling data today, it still favors a Trump win even after Harris replaced Biden as a Democrat candidate, which of course has kept markets focused on potential Trump trades, such as domestic stimulus winners, an example of that being the US financial sector equities and the risk from his proposed tariffs. However, we'd caution we're still 3 months away from the election itself, and a lot can happen over that period of time. And more than the presidential election itself, the composition of the House is also quite important. And polls show that's a much closer call because that defines just how much leeway is likely to exist for the US president, particularly when it comes to the domestic policy agenda. So, Fed rate cuts and US elections, we think those are the two narratives that are front and center for markets at the moment.
In a rate cutting environment, there are bound to be winners and losers. How does that translate to our asset allocation?
Well, in a few different ways. I think at a very high level, we still expect equities to outperform cash and other major asset classes. But we would caution that this outperformance is likely to come with more volatility than we experienced in the first half of the year. Now, on a shorter horizon, we do think excessively optimistic investor positioning does remain a key challenge, particularly when it comes to US equities. Now, our own proprietary indicators warning signal did abate after flashing a warning sign a few weeks ago, but other data sources suggest broader measures of investor positioning remain quite optimistic, and cash levels by many measures remain on the lower side. So, this combination, we think, creates conditions for pullbacks, and indeed, we've trimmed our own US equity overweight marginally, though of course we remain overweight for the US from a regional perspective. We would qualify that by saying that, look, pullbacks driven by positioning do tend to be short-term in nature. So indeed, if we see more pullbacks, and indeed more beyond what we've already seen, we'd see them all as attractive buy-on-dip opportunities. So looking out a little bit further, that's a short-term outlook, of course, but we remain overweight US equities on the 6 to 12-month horizon because we believe positive US growth should ultimately support continued earnings growth. We're a little bit more muted when it comes to Euro area equities because of the softer growth outlook over there, and Japanese equities because we think the technicals still look a little weak. In Asia, Japan, within the region, we're overweight Indian equities. Valuations undoubtedly the most debated point there, but we do believe the growth outlook and a focus on large cap equities can help mitigate concerns. Chinese equities, though, for us more of a core holding because we haven't really got any fresh catalysts over the past month. That's, of course, on equities, but when it comes to bonds, it goes back to what we discussed earlier, where expectations of Fed rate cuts, they really remain the key driver. So it reinforces our view that bonds ultimately offer opportunity to lock in yields for longer, which is why we prefer high quality bonds over cash, particularly since cash would be front and center at risk if the Fed indeed starts to cut rates. I would say it's harder to find value within bonds. We believe EM dollar government bonds are one pocket of value where spreads are a little bit wider than what you can find elsewhere. And look, stress does exist in several individual EM markets, but we do believe this valuation premium more than compensates for the idiosyncratic risks. So that's one pocket of value.
Quite a bit are covered there, but currency seems to be missing, right? How would the dollar and other major FX pair perform in a lower interest rate environment?
Indeed, I'm glad you pointed that out because if I step back for a moment and look across asset classes, I think one of the most notable events in markets over the past month has actually been the rebound higher in currency market volatility. And this was most visible in dollar yen, where suspected policy intervention pushed the currency pair lower. And we think that pair actually has room to extend decline significantly below 150, given what the Bank of Japan is telling us about the willingness to tighten policy and strong technical momentum. That move, of course, did also coincide with a move lower in the US dollar index, given the Fed discussion, rate cut expectation discussion we had earlier. Having said that, we do not expect this volatility to break out of the range of volatility we've experienced over the past 12 to 18 months. So what that means is that the move lower in the dollar might very well extend over a 1 to 3 month horizon as we continue to focus on this discussion of just how far and how quickly the Fed could cut rates. But that suggests there's some room for that move to reverse over a longer 6 to 12 month horizon as non-US central banks also continue to cut rates in parallel and thereby keep the differential in a range. So what that means more beyond the dollar, of course, is that we view rebounds in major currencies like the euro as an opportunity to sell on a longer horizon of 6 to 12 months. The yen really being the only exception, given that Bank of Japan policy remains quite in contrast to what we're experiencing elsewhere.
Lastly, let's quickly touch on commodities, in particular gold, which historically has a strong correlation with bond yields.
Now, gold is an asset class we continue to see as a solid core holding. We've discussed before that our constructive view is based on what looks like a tight demand supply balance and our expectations that bond yields in the US will continue to fall. So, recent data over the past few weeks continues to support these arguments, especially with Fed rate cut expectations on the rise. I will say that gold is sometimes cited as another Trump trade, and some of that is attributed to just how much it rose during Trump's first presidential term. But we'd also note that the range of returns can be quite wide if you go back in history and look at gold's performance across Republican and Democrat presidents. So we'd be a little bit more careful about stretching that analogy too far. Having said that, look, we have a positive view, but we do think it's a solid core holding, one worth implementing, but magnitude of gains, of course, might struggle to beat what we expect on equities, at least over a longer 6 to 12 month period, given gold's lack of yield. So, solid core holding, perhaps not all the way to an overweight.
As usual, the key takeaways for me are firstly, Fed rate cuts are aimed at supporting growth rather than fighting inflation, and that backs our preference for equities over cash and other major asset classes. Secondly, cash would be most at risk from a Fed rate cutting cycle. We would instead lock in opportunities in bonds to earn income over a longer period. And lastly, gold should benefit from lower interest rate and bond yields. Thank you so much, Manpreet, for the insightful sharing. If you have made it so far, we'd like to thank you for following yet another episode of Through the Noise podcast. Have a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.